Hey, what's going on, everybody? My name is Ryan. I'm a CPA, and today I want to talk about how some ways millionaires use their money and how they manage their taxes. And I figured this would be good information to share because if you're wanting to become wealthy, if you're wanting to become a millionaire, it might be good to kind of follow in the footsteps and do the same things that most millionaires do. If you're a millionaire, that just means you have net assets greater than $1 million, right? Doesn't mean you're making $1 million a year. It just means you've saved up enough to have net assets greater than $1 million. Now, some people might get into more specifics and more nuances of that, like, maybe the assets need to be liquid, or maybe the assets can't include their home. Whatever that means to you, this is what I've found wealthy people do to manage their taxes. When you're making higher money, higher income, you might see that your effective tax rate will be between 24 and 37% federally, and then whatever your state taxes will be. Okay. Now, if you're anything like me, I find that that's unacceptable. That's too high. So one thing that millionaires do, or wealthy folks do, is they have a lot of investments in stocks, bonds, ETFs, mutual funds, those kinds of things. And why is that more favorable? Well, those investments tend to increase in value, over time. You take any, over a lifetime of the stock market, it has always increased in value, right? There might be some dips and some bumps in the road, but it always eventually increases in value. So with those increases in value, those are called capital gains. If you held a stock for longer than a year and you sold it and it increased in value, you get taxed on capital gains tax. Now, these capital gains taxes are a much more favorable tax than your ordinary income gain tax. So for most people, capital gains tax is right around 15% federal, and then factor in state if you have income tax for your state. For the people earning the highest amounts of money, the people in the top tax bracket, the capital gains tax rate is 20%. And so between 15 and 20%, that is a much more favorable tax rate than ordinary income. And so once you have accumulated enough wealth and you have it in the market, basically your money is working for you, it's growing for you, and as it's growing and you need to access that money, it's taxed at a much lower rate than if you were working. Another way that millionaires manage their taxes is by deferring their income. So many people who are wealthy, they have their maybe upper 20s to mid 40s of their lifetime where they're making a lot of money each year. We'll call these high earning years. And now during these high earning years, because you're making a lot of money, you are subject to a higher tax bracket for a lot of your income, right? So if that's the case, then it might be a good idea to defer that income to a later year where you're maybe not in a high earning year, so that portion of your income is not subject to the higher tax brackets. Now, the very most basic way to defer your income, obviously, is to contribute it into a 401k or an IRA or some sort of IRA, traditional retirement funds. These contributions are deductible in the year that you contribute them, and they become taxable when you withdraw money from these vehicles. Now, obviously, these vehicles are limited, so if you contribute money into them, you can't withdraw money out of it until you're 59 and a half. Otherwise, you face a 10% penalty from the IRS, and that's on top of income tax. So that's one way that wealthy folks manage their taxes is they look ahead. They look way ahead in their life. Okay, maybe when I'm 50 or when I'm 60, I'm not going to be making as much money, but that's a good time to be able to access the money that I save away right now. That way, I'm deferring my income. Now, there's other ways to defer more income than that. I'm not going to get into those right now, but just know, if you're consistently contributing money to a 401k and you're a high earner, you're doing your future self a favor. One, by saving on your taxes now, and two, by putting away money for later so you have access to it for later. Another way that wealthy folks manage their taxes is by using Roth IRAs. Now, Roth IRAs are not really, there's limitations here, because if you make over a certain amount of money, you're suddenly no longer allowed to contribute to a Roth. So, you might think that Roth IRAs are then by design not meant for wealthy folks, right? Because if you earn too much money, you can't contribute to them. Well, that's, there's a back way around it, and I'll explain that in a second. But what's a Roth IRA? Well, I just explained to you what a traditional IRA was. A Roth IRA is not a way of deferring your income, but it's a way of allowing your money to grow tax-free, and it's a way to let you access your money in the future tax-free. So before I mentioned like a 401k or a traditional IRA where you contribute money and it's tax deductible in the year that you contribute it. With a Roth IRA, if you contribute money, it's not deductible. Okay, you don't get a deduction for it. However, when you withdraw it in the future, it's not taxable either. Any growth that you made in that account during the years are also not taxable, which comes as a big draw for many people. Now, if you were to set aside line by line, year by year, if you contributed $6,000 to an IRA and $6,000 to a Roth, and you had them in the same investments, and you pull them out at the same time, at the end of let's say you're 60 years old, you pull them out at the same time, essentially you end up with the same dollar amounts. Taxes, with the way that tax treatment of the traditional IRA and the tax treatment of the Roth IRA, essentially you end up with the same dollar amounts. So why would you even contribute to a Roth? Well, part of financial planning is having your money spread out in different vehicles, taxable, deferred tax, and non-taxable buckets. And this is a good way to plan your future so that you're not taking too much money out of your taxable account, you're not taking too much money out of your deferred tax account, and you're not taking too much money out of your non-taxable account. You can spread it among those accounts, and you can strategize how you pull money from them when you get older. As I mentioned before, if you make too much money, you can't contribute to a Roth IRA. So what people do is they do what's called a backdoor conversion or an IRA recharacterization. What this is when you contribute to a traditional IRA, you can then recharacterize it or convert it to a Roth IRA. And there's no income limits here. So it's just like an extra step. You're essentially doing the same thing as contributing to a Roth, but you're just doing it in a backwards way. And it's called a backdoor Roth. And some people might have some innuendo comments about that nomenclature, but that's okay. That's what it's commonly known as. And the last very common thing I see with wealthy folks is that they are business owners. Now, I'm not saying go start a business just to take deductions. That's some typical TikTok advice, and I think that's pretty BS. But mostly, when you're a business owner, right, your income potential is limitless. Whereas if you're a salaried employee, you're more likely to be limited by your market value of your salary. But when you're a business owner, your income potential is limitless. Also, with tax planning and tax advisory, having a business gives a lot more options and a lot more creative ways for people to plan with their taxes and how to reduce their tax liability. It's just simply the case. With the W-2 income, and then if that's the only source of income you have, you're pretty limited to what you can do for tax strategies. But with a business, you have a whole plethora of strategies that you can access. You can set up retirement plans for yourself. You can set up deferred compensation plans, cash balance plans for yourself. There's a whole array of tax credits that you have access to when you have your own business. There are hiring strategies. You hire certain people, you get tax credits. There are strategies where you rent your own house to yourself or to your own business. There are all these leasing strategies that you can use for your business. Deductions, the laws are always changing for businesses, especially. Think of when COVID happened, think of when the pandemic happens. The PPP loans were a huge deal to help businesses get through those tough times, right? If you remember that, there was the PPP loan, there was the EIDL loan, and those monies were just easily and readily available to business owners. Yes, they were meant to get businesses through a hard time. And if you remember, regular citizens, individuals, only got like $1,200 each year or whatever, $1,400 and then $1,200, while business owners got, tens of thousands, hundreds of thousands of dollars through the PPP loan or the EIDL loan. And so what I'm saying is having a business can open you up to a lot more opportunities when you're planning for your taxes and you're planning financially. I'm not saying you should go open a business. Like I said, it's not for everybody, but this is a common thing that I see among wealthy folks. All right, that's all I got for today. Thanks for joining me. If you liked this content, please smash the like button and please consider subscribing if you're new here, if you're returning. Thank you for your support. I appreciate you. I'll see you next time and take care.
They act like they know. Guess I gotta hit them with an update. Okay. I been getting to it when I'm up late. Hit it when you at the front gate. They act like they know. Hold up. Guess I gotta hit them with the update. Really with it, I ain't got a pump fake. Killer flow and hit him with the one take. Act like they ain't know. Guess I gotta hit him with the update. Okay. I been getting to